Welcome back to the channel, everyone. Thank you for joining. Today we have an amazing guest. We have Adam here. So a bit of a backstory. I'm sure a lot of you guys know, I have bought my very first property in 2014. And the gentleman who made it actually happen in terms of the mortgage process and getting me the right lender is this gentleman here, Adam.
Hello.
Hello. Thank you for joining.
Thank you for having me.
No problem at all. So today we're going to go and speak about all of the myths and all the things that you guys need to know about mortgages. Adam is a qualified mortgage broker. Who are you?
Hello, so my name is Adam. I work for LDN Finance. I've been doing mortgage advising now for 12, 13 years. I think you were one of my very first ever clients, actually, back then, 2013, 2014. We specialise in residential mortgages, buy-to-let mortgages, commercial development, bridging. So anything to do with property, I can help you and advise on.
Awesome, thank you. So what we're going to talk about today is all the things that people normally need to understand when it comes to the mortgage process. So one of the very first questions that I want to ask and just help people to understand is, what are the key differences between a fixed rate and a variable rate mortgage?
So the main difference is quite self-explanatory. So a fixed rate, I suppose, is going to be fixed for the period of time that you're on that particular mortgage. So you tend to have 2, 3 and 5 year fixed rates. So a 2-year fixed rate will be fixed for 2 years, 3 years for 3 years, 5 years for 5 years.
Okay.
A variable rate can vary depending on different parts of the market.
Okay.
So a variable rate can typically be a base rate tracker. So you've probably heard a lot about the Bank giving a base rate recently, going up and down. So if you're on a base rate tracker, if the Bank giving the base rate drops, so will your mortgage rate. There are other lenders who will offer slightly different variable rates where they are based on the lender's own variable rate. So they have their own variable rate, and if their variable rate drops or goes up, then so will your mortgage rate. So a fixed rate is fixed for a certain amount of time. A variable rate can change depending on market conditions.
Do you normally suggest or recommend that people go for certain different products depending on what season it is with interest rates, or do you give them the options and let them decide?
We would always ask them what their plans are, what they want to do with their property, with their mortgage, what their long-term and short-term plans are, so we can make a formal recommendation to them about a suitable recommendation to them about their plans and circumstances. What we tend to find is that most first-time buyers do often go for a fixed rate, and the higher the loan to value that you have, so the higher the loan compared to the property value, loan to value. So if you're sort of 90%, it means you're borrowing 90% of the property value on a mortgage. The higher the loan to value, typically the more attractive a fixed rate tends to be, because the variable rates tend to be a little bit higher than fixed rates at the moment. Makes
sense. You mentioned before about interest rates and that affecting what the products are. And how do mortgage interest rates actually work? For in layman's terms, how do they work and what factors influence them that people should be aware of when they're applying for a mortgage?
So there are several ways. That's a good question. One of the big ways that fixed rates are influenced by the moment is something called swap rates. So swap rates are effectively the cost of money, the cost the lender incurs in borrowing that money from the money markets.
Okay.
So we have seen swap rates being quite volatile over the last few years. In terms of where the fixed rates are, then if the swap rates are going up, fixed rates tend to be higher. The swap rates are going down, we tend to see that reflected slowly in fixed rates, while they tend to drop. Bank of England base rate trackers are essentially following the Bank of England base rate, so it's quite easy to follow, as opposed to a swap rate, which is a bit more ambiguous. And in variable rates, the thing with variable rates that are not Bank of England base rate trackers is that they are subject to the lender's opinion on the market as well. So even if the Bank of England base rate drops, the lender might not reduce their own internal variable rate. They might follow that a few months later.
I didn't know that.
Yeah. So the variable rates don't always follow the Bank of England base rate. Typically they have done as a general rule of thumb, but not always.
I see. Okay, so when you do get approached by first-time buyers, and obviously there's loads of schemes, and even myself actually, when you got me my very first mortgage, it was a 5%, 95% loan to value, so I put down 5%. Do you think the 5% mortgages 5% deposits are a good idea? And how much do first-time buyers actually need?
So first-time buyers can buy with a 5% deposit.
Yeah.
There is a lender who will do a 100% mortgage.
In this day and age?
In this day and age, yeah. It's very subject to criteria meeting certain parameters. And there's even a lender who will do a 1% deposit as well. The difficulty with those sort of options is that credit scoring tends to be quite tight. So to pass with a 1% deposit, you have to have a very good credit score as a general rule of thumb. Aside from those two anomalies, I suppose if a first-time buyer's got 5% or 10% or 15%, they're eligible to buy a property.
Okay.
The difference is obviously with a 5% deposit, the rate is going to be a bit higher. If you put more deposit down, the rate is going to be a bit lower.
Okay, so with the 1%, because I'm actually quite intrigued by that, I know you mentioned the credit score has to be quite high. Is there any other criteria that they need to be aware of?
There would be there's a maximum loan size.
Okay.
I think it's up to 500,000. And then again, it all depends on things like affordability as well. So if you're able to pass the affordability test, because you're borrowing quite a big amount of money, a large amount of money. So there are a couple of options to put down less than 5%. But generally speaking, if you've got 5%, you're going to have access to most of the market in terms of lending. And then when you put more than 5% down, when you get to 10% or 15%, you'll then start opening yourself up to more and more lenders and better rates.
That makes a lot of sense. And you mentioned about your credit score. What are the other things that lenders look out for when you're doing a mortgage application that I think people who want to get into the buy-in market need to be really aware of?
So things you need to be aware of when you're first time buying or just buying a property in general. You need to make sure that ideally you're up to date with your credit commitments. Obviously we're living at the moment in a cost of living crisis. Things are very tight for people. We understand that not everyone is able to make all of their ends meet. So we do understand that sometimes people do miss payments, whatever it might be. So in that circumstance, it doesn't mean it rules you out of a mortgage. It just might limit the lenders you can go to. Aside from keeping up your credit commitments, you probably want to be on the voters roll where you live. That's a very key point. You will need to be aware of your full 3-year address history, ideally. Lenders want to be able to find where you've been for the last 3 years to make sure that you've got a valid UK sort of footprint in the UK. Make sure that you've got a valid proof of address with your name spelled correctly on that proof of address as well. That's kind of the bigger points we need. Just basically knowing who you are, where you've been for the last few years.
And you've been, like I mentioned before, you helped me get my very first mortgage in 2014, so that was 11 years ago. Has the mortgage industry changed over that time? Because you've been in it for a very long time. Have you seen things come, go, change, adapt?
Absolutely, yeah. The mortgage market feels like it's constantly evolving. We're dealing with things today such as AI, a much more automated process than even it was 11, 12 years ago. We've gone through parts in mortgage reviews, whether it was a mortgage market review in 2014, I believe it was. We've then seen Brexit happen. We've seen obviously COVID come and go as well, which impacted lending policy. We've seen the Liz Truss budget that came in as well, and obviously we saw rates go up as a result of that. And the way that also, which we may not go into great detail today, but things like the buy-to-let market has changed as well. We've seen a massive influx now, or a massive growth, in limited company buy-to-lets over the last 11 years or so, whereas in 2014, it was a lot less common. Yeah. So we've seen, there's been a huge amount of changes.
Definitely, especially when it comes to the limited company purchase, I'm definitely a big candidate of that in terms of we've done so many mortgage applications now by a limited company.
Yeah.
And something we didn't even think about when we first got our mortgage, thinking that this will be the trajectory of how the mortgage industry changes. So yeah, it's really interesting. And so when it comes to, again, just speaking about first-time buyers, because I'm sure a lot of them really want to get things right the first time round, what are some of the biggest mistakes that you've seen that people make when applying for a mortgage when they are first-time buyers that they maybe haven't been aware? I know you mentioned the electoral roll, having a good credit score, but what are the biggest mistakes that first-time buyers make that you've seen in your experience?
Good question. I think probably the biggest mistake people make is just having a presumption about what they need to do or where they need to be or what they need to get a mortgage. People assume you need a 25% deposit, or people assume that you need a big income, or people assume that you can only use certain amounts of income. Or probably the biggest mistake we do tend to find is being told something by someone else that they know who's got a mortgage in the past, because you've got to remember that everyone's circumstances are very different to the next person. So you can have a conversation with your friend who's got a mortgage because they did X, Y, Z, but you're not able to do that as a first-time buyer because your situation is completely different. It's all about just sort of seeking professional advice from whoever, and making sure you get the right advice rather than making assumptions based on what you read or hear through the grapevine.
Okay. And then when it comes to the actual person, what can they do to increase their chances of getting approved? Is there anything that they can do, or is it literally subject to that particular person?
It's all down to the individual, but you've got to remember that if lender A doesn't want to lend to you right now, it doesn't mean that lender B, C or D won't lend to you, because every lender's got different criteria, different credit scoring, different ways of checking your background and things like that. So it doesn't mean that you've only got one option on the table, or if one lender rejects you, they're going to say no. You just have to, I think the key things to be aware of when you're buying for the first time, particularly if you're living at home with parents and you don't have much credit in terms of credit cards or loans, it's not to encourage you to go out and get credit cards and loans. It's just to say, make sure you're on the voters roll, make sure that everything is as accurate on your credit file as it can be. So sign up for a credit agency or get your credit file online, download it. There are free ones out there, I think, so you can do that, and just make sure that your name's shown correctly, that, like I said, that you're on the voters roll, that your address history is accurate, so that when we do a mortgage application, it all matches up. So there's no discrepancies on when the lender tries to do a credit check against you. So
what are the best mortgage options for first-time buyers right now? Is there a particular lender that you've seen? Obviously, this isn't financial advice, but are there any?
I mean, all the high street lenders are happy to lend to first-time buyers. So there's no particular lender that is better for first-time buyers than others in terms of, from a generic point of view, because there are some lenders, for example, who will, if you're a first-time buyer and you're happy to go on like a long-term fixed rate, there are some lenders out there who will lend you a bit more. But some people don't want a long-term fixed rate, so might agree to borrow a little bit less to go on a bit more of a flexible two-year product. It all depends on the individual circumstances. But in terms of first-time buyers, every lender is happy to lend to a first-time buyer.
You mentioned about the longer term for the fixed rate. Are you seeing more first-time buyers go for the 5-year rather than the 2-year option, just to lock in the rate? Because obviously interest rates spiked recently, well, say recently, a few years ago. Are you seeing that people are locking in for longer out of fear? Or
no, not necessarily. I think if someone wants to perhaps borrow a bit more than they can on a 2-year and they have to go for a 5-year, they might choose the 5-year as a way of doing that, knowing that they're going to be in the property for the next 5 years, if that's the plan. There is a general expectation that rates may come down over the next couple of years as well. So again, that might influence people to go for a shorter term fix and perhaps speculate a little bit on interest rates coming down. What we would always do is have a conversation with the client to make sure that they understand the pros and cons of both the shorter term products and the longer term products, what fits their lifestyle, what they think they're going to do. No one can predict the future. No one knows what's going to happen next week, let alone in 2 years or 5 years time. But we can have an understanding about what they're hoping to achieve and then make a recommendation based on that. And our recommendation doesn't always have to be what the client follows. They can tell me what they prefer as well. And we can say, okay, well, in that instance, we can recommend this one. As long as we're on the same page, then everyone, we can give the right advice.
Okay, moving away then from first-time buyers to those who are getting into property investing and buy-to-let mortgages. What is the difference between a residential and a buy-to-let mortgage?
So the main difference, the big difference, is that a residential property is to live in, and a buy-to-let property or buy-to-let mortgage is used on the property that you're buying to let out. So a residential mortgage, for all intents and purposes, is a regulated contract. So it's all based on your personal affordability. You're going to live in the property, and that's going to be your main home. A buy-to-let mortgage is an investment product, so it's unregulated as far as the FCA is concerned. It doesn't mean it's not covered or protected in any way, but it's just a term that we use called unregulated mortgage, unregulated contract. And it's based generally on how much that property can generate as a yield in terms of rental income. So with a buy-to-let mortgage, you typically need a bigger deposit of around 25%. the lender would expect the rent to cover the mortgage at a certain stressed level as well. So they would stress the mortgage payment, and then they would expect the rent to cover that at a further notional amount. To complicate, there's a calculation in place to work out what a client could borrow on a buy-to-let mortgage, but the fundamental difference is one is to live in and one is to let out.
You just mentioned there's a stress test that needs to be done, but so how do they assess affordability for the buy-to-let? I know you mentioned the rent has to cover the mortgage. Is there anything else?
So there are several. So obviously this varies lender to lender. This varies from person to person and criteria from each bank. Effectively, you've got. What's my train of thought now? What was I saying? Buy-to-let lending.
Yeah, buy-to-let lending.
You've got the certain parameters. So initially, for all those purposes, you've got to be able to meet a certain number of parameters with a lender. So if you're an owner-occupier, so you own and live in your own property, and you earn a certain amount of money per year, and you've got a 25% deposit, you can pretty much qualify for most lenders' buy-to-let policy. So if you're meeting those three boxes, then great, we can look at buy-to-let mortgages. If you don't hit one, two, or even tick three of those boxes, then you can still get a buy-to-let mortgage, but it's just going to be a bit more of a narrow pool of lenders potentially. When it comes to calculating how much you can borrow on a buy-to-let, there are several differentials of how we can look at it, but effectively what you need to think about is you can borrow less on a 2-year fix and more on a 5-year fix. And then we break it down into things like, are you buying in a personal name or are you buying in a limited company name? If you're buying in a personal name and you are a higher rate taxpayer, typically and perversely you can borrow a bit less than if you're a basic rate taxpayer because of how now the rental income is taxed in the UK. So again, if you're a basic rate taxpayer buying a buy-to-let in personal name on a 5-year fix, you can borrow a lot more than if you're a higher rate taxpayer buying a buy-to-let in personal name on a 2-year fixed rate.
I didn't know that.
So that's a couple of things to factor in. If you're buying in a limited company name, then typically your amount you can borrow is the same because they then base it on the tax that you're getting charged as a limited company rather than in personal name. So once you decide how you want to buy the property, is it in personal name or limited company, then we look at your tax situation, work out what your max lending is going to be based on the rental income that property is going to generate. That rental income will be stressed then at a rate determined by the lender. So if, for example, if the bank is charging you 5% for the interest rate on a buy-to-let, they might stress test the mortgage payment at 6.5%. So what they'll effectively be saying is, how much will your mortgage payments be on interest only if the mortgage rate went up to 6.5%? And then what we will look at then is we want the rent that you're getting to cover that mortgage by an amount, be it 125% or 145%, depending on if you're a basic rate taxpayer, limited company or higher rate taxpayer.
Makes sense.
So if you want to borrow X amount of money, the rent will need to be this amount to make sure that it can cover that mortgage payment.
That's actually really interesting. I didn't realise all of that. You've just mentioned obviously the stress testing for buy-to-let investors. Not recommendation, but should landlords buy in a personal name or limited company name?
So we'll always preempt this or always caveat this with seeking tax advice. Always seek tax advice before deciding whether you want to buy in personal name or a limited company name. I think the general rule of thumb now though is if you've got a number of properties and you're expanding your portfolio, the majority of landlords are now doing this in a limited company name.
Is there a certain number?
I don't believe so. I think it depends probably on a combination of what your income is, what your intention is with the property as well, because I believe if you're going to use it for income and to live off a rental income, then it depends on you're going to be drawing that out, because if you own it in personal name, then you're going to be obviously personal tax liability, which you'd have it anyway. If it's a limited company name, then you're going to have corporation tax plus anything else you draw down as personal income from that company. So that's why it's always important to get the tax advice when buying a property as a buy-to-let.
So do the lenders treat people with multiple income streams like a side business, or how do lenders treat people with multiple income streams?
For residential or for buy-to-let?
For buy-to-let.
So for buy-to-let, the income becomes less sort of important because so it depends on the type of product you're going for. As a rule, once you meet the certain thresholds for buying a buy-to-let with that lender. So as long as you tick the minimum criteria boxes, they'll generally base it on what the rental income is going to be from that property. Now, sometimes there are some lenders who will do something known as top slicing, which is if the rental income being generated by the property isn't enough to meet the rental stress test that we talked about earlier, if you've got enough disposable income through another calculation, then we could use that disposable income to enhance the borrowing that you've applied for, to make the shortfall up. It's not offered by all lenders, and typically it's done in personal name rather than limited company. So that's another way of perhaps borrowing a bit more in a personal name on a buy-to-let than it would be otherwise if you've got a good enough income to support that mortgage. In the limited company name, generally the lenders don't really look so much at your income and where it's coming from. As long as you can evidence it and verify it, that's fine.
That makes sense, I guess. So moving on then from that, well, a bit in the middle, I speak to a lot of clients who have a first-time home and they want to be able to pull money out and start the property investment journey, which I always tell people it is not a get-rich-quick scheme.
Yeah.
Property is definitely a long haul. It's a marathon. You need to be patient and take your time when doing it. But in terms of refinancing, if someone wants to remortgage their property to be able to pull money out, can you just explain how the process of remortgaging works?
Yeah, so when you're remortgaging, you're essentially looking to, whether we're doing a like-for-like mortgage, so you just take your fixed rate or your current product is coming to an end, and you want to move that mortgage you've got there to a better deal with another lender, because when your product ends, you go on to what's known as the standard variable rate. Now, the lender's standard variable rate is typically at the moment around 8 or 9%, depending on the lender. So you don't want to be on that for long, if at all. You want to try and get off that rate and go on to a new rate with either your existing lender or another lender. So whether you are moving your mortgage to another lender and keeping everything the same, or you want to borrow more, you're remortgaging. So what we're looking to do is just basically taking that mortgage, that money that you owe the one bank, and giving it to another bank. So we would look to, a remortgage application is essentially just changing the lender.
Okay.
When you want to refinance to pull money out, again, that's absolutely fine. Typically, as long as it's for legal purposes and within the lender's criteria for capital raising, then again, it's just, and it meets affordability. So again, it's a few other checks. It has to meet affordability always. So if your income has increased significantly over the last few years and you can afford to borrow more, then the lender's happy to lend it to you as long as it meets all the other criteria. And of course, doesn't exceed the loan to value limits the lender allows for remortgaging.
Okay, that makes a lot of sense. But in terms of, interest rates, they were quite high and they're coming down now. If someone has time to be able to remortgage, I know typically they can lock in 6 months prior to the product ending. Is now a good time to remortgage, or should people wait until there are better rates?
So the time to remortgage is always going to be determined by the date that your current mortgage ends. So if your mortgage is ending next month, then now is the time to remortgage. There's no point in waiting. If your mortgage is ending in December, it's still a little bit early to be locking something in, because mortgage offers tend to be valid for 6 months. So if we did an application today, your mortgage is going to expire in October time, let's say. So that's bad maths, August, September time. So it's a little bit early to do it now, so it all comes down to timing, but you're right, 6 months in advance is typically a good time to start looking at new mortgage rates. And the reason why that's beneficial is because not only is a mortgage offer valid for 6 months, you're never tied into that deal. So you can get a mortgage offer from the lender, and your broker can then monitor the market, make sure rates are staying where they are. If anything better comes along, that rate can be changed if that lender reduces their rates. If the lender increases rates, then you've got a deal already. If a new lender comes along with a better rate, time permitting, and obviously making sure you have a conversation with the broker about the risks of doing this, you could potentially apply to a new bank to get a better rate and leave the one that you were going to originally. So it's all about advice, and it's all about timing. But yeah, is there a good time to remortgage 6 months before your deal's coming to an end?
That's really important. I think a lot of people probably don't realise that if they get a rate or a mortgage offer, they don't have to go for it. They can shop around up until the time that the product ends. I think that's really important, that people need to understand. You're not tied in. You're not tied in. You're not tied in.
And it's all about just speaking to someone who can give you the benefits and the pros and cons of changing, and when to change and when not to change.
Makes sense. So how do lenders calculate how much someone can borrow?
So Historically, and still today, people talk about income multiples. 4.5 times, 5 times income. So it's not a bad way to gauge how much you can afford to borrow, but it's now based on affordability. Because if you're 21 years old and you're earning an income of, let's say, £50,000 a year, trying to borrow 4.5 or 5 times that amount. Oh, so let's start again. If you're 21 years old and you're a first-time buyer living at home with parents with no credit commitments and credit score is good and they've got a good record of you, borrowing 4.5, 5 times that salary should be fairly feasible because you've got no other outgoings. You can stretch the term to make sure you can borrow as much as you possibly can. If you're 55, 60, buying your first home, and you've got a car loan and credit card debt, and you're earning £25,000 a year, trying to get to 4.5 or 5 times that amount is going to be a bit more difficult. So lenders calculate their affordability or how much they can lend you based on affordability, based on how much you earn, how old you are, what your credit commitments are, and that all comes into the affordability calculator, and that will determine then how much you can borrow.
Amazing. Quite a lot of people, I've heard this 4.5 times rule, but you're right, I didn't actually think about the credit commitments you actually had, because if you make £1,000 a month, but your bills are £750, you actually only have £250 to play with.
Correct, yeah.
So that makes a lot of sense. So when it comes to the debts and financial commitments that people have, how does that affect how much you can borrow?
It will vary from lender to lender.
Yeah.
It will also depend on what's happening with those commitments in the short term and long term. So are those commitments going to be gone, or are they going to remain? How much they are compared to disposable income. So there's no hard and fast rule. So some lenders will lend you, if you've got credit commitments, it's not like you can multiply those credit commitments, deduct them from your gross salary, and then that's your sort of net salary that we can then multiply by 4.5. It's not as simple as that. It all varies from lender to lender. So what you'd look at is what those commitments are, how much are they of your income, because some lenders will remember have a debt to income ratio as well. So if you've got too much debt, they won't lend to you at all because your debt is a percentage more than a certain percentage of your income that is quite high. So, you want to, and obviously it's all about lending responsibly. Lenders want to make sure they're lending you money that you can afford to pay it. It's not about saying, the lenders don't want to say no to you. The lenders want to lend you the money as long as you can afford it. So there's no hard and fast rule. It just comes down to the individual lender's calculations.
Another thing, obviously, debts, financial commitments is one thing, but when you have children and you have dependents, how does that affect your mortgage application?
So, unfortunately, children do cost money, as we both know.
Yep.
Children, having children itself isn't so much of a deal breaker unless you've got a family of 15, in which case it's going to be very expensive. If you've got a couple of kids, we have to make sure there's noted on the application form. And having the financial dependence could impact how much you can borrow. Doesn't necessarily will impact, but it could impact. The main thing is childcare costs. How much are you paying in childcare costs? They have to go down on the application as a commitment. How long are they going to continue for? Because we know now you get, certain people can get 3 hours, up to 30 hours a week. There's tax-free childcare stuff that you can get as well, depending on if you meet the certain requirements. And of course, then when you hit 4, you start going to schools. Then obviously, in theory, your costs will reduce. So it's all about knowing the whole story, the full background of a client's circumstances to work out how that can impact on how much they can borrow.
So financial commitments you've mentioned, children we've mentioned. In terms of loans and credit card debts, how does that affect your mortgage application as well?
So credit cards. So loans are quite straightforward. If you're paying £300 a month on a loan, that will go down as a credit commitment against your affordability. So you've got £300 less disposable income than you've got to spend on a mortgage. With credit cards, they typically will lenders look at a percentage of the balance that's outstanding at the point of application. So if you've got a £10,000 credit card outstanding, a lender might use 3 or 5% of that amount to work out your monthly payment. So that would be maybe £500 or £300 a month as a commitment. Again, that's all what goes on the affordability calculator and determines then how much you can borrow with those in place. If those credit commitments are going to be cleared, then some lenders can ignore them. They could ask for evidence of how it's going to be cleared. But yeah, effectively, we just have a conversation around what these debts are, how long they're going to continue for, and how that impacts on someone's affordability.
And another important thing, because I've always been told when you're trying to apply for a mortgage, especially as a first-time buyer, you need to have been in your job for X number of months. Is that true? Does changing jobs impact your mortgage application?
No, no. So as long as you've got a record of employment, so if you're employed and you've got a job, you can get a mortgage. You in theory can get a mortgage. So as a rule, we would ask for 3 months pay slips. A lot of lenders will ask for 3 months pay slips to show steady income stream. But obviously we're aware that some people change jobs. So if you're changing jobs, it doesn't mean you have to have 3 months from that job. You can have 2 months from the previous job and 1 month from the new job. You could, in theory, have a new job starting, and we could potentially use that income as well. There are various ways. You don't have to have. There's different ways of looking. There's different lenders will look at your income in different ways. So you can be. Some lenders want you to have steady employment for 6 months. Some are happy to have 1 month. Some are happy to potentially, if you're starting a job with a contract in place and we can see it signed and, all seem, we can do our due diligence on that company, then we could use that contract as well for a new job starting in the next month or so.
And then you've obviously mentioned different banks have different criterias. Are banks becoming a bit more strict or a bit more lenient in their lending criteria from what you've seen?
I would say that it changes quite regularly depending on market conditions. So when the mortgage market review came out in 2014, we did see lenders trying to, because whenever changes in regulation come along, we have to sort of try and figure a way through the changes. So lenders tend to be a little bit more conservative at that point. When rates started going up after the mini budget, which was 3 years ago now, maybe, I can't remember, but that then we saw lenders increasing their rates, making sure affordability was met, so affordability got a bit tighter. I'd say we're in a place now where lenders are definitely more flexible in their lending. They want to lend money. Lenders have targets too to hit. They want to get the money out there to people if they feel they can afford it. We are seeing a lot more lenders actually coming up with more innovative and interesting criteria to help people who historically have struggled to get on the property ladder because of visas or lower deposits or multiple income streams, like you said before. So it's all about just lenders want to try and lend the money where they feel there's a good need to.
Definitely felt that in terms of the lenders being stricter a few years ago, because I know a few mortgages that we've had to put down a much bigger deposit because the criteria was just, I don't know what was going on at that time. It just seemed like everyone was either downvaluing or making the criteria a lot stricter, that the 25% buy-to-let wasn't cutting it. You had to just do more.
Yeah.
But I'm happy things are going down the other way now.
I think that was probably due to rates, because when rates are high, then the amount that your rent needs to be higher as well. And so as a result of that, then you need because what we were finding is rates were going up, but rental values weren't so much. So what we were finding then is the rents were staying quite stable, but then the rates were going up. So although landlords were trying to charge more, the valuers didn't feel the rents were justified. So obviously you had to earn more in rent. If the valuer didn't give that rental value, then you had to put more of a deposit down.
Oh, is that why?
Yeah.
Oh, interesting. Oh, I didn't realise that. Okay, so moving on to that and people trying to become financially free and do more with their money, how does overpaying a mortgage work, and should people do it?
So most lenders will allow you to overpay by 10% of the outstanding balance per year. Again, it varies from lender to lender, and it varies in how they calculate this 10%. Some lenders allow you to do 20%, but let's say 10% for now. Let's assume that it's done on a calendar year. So in January, you can overpay 10% of the outstanding balance, and then the following January it'll reset, and you can overpay by another 10% of that balance then at the start of the next year, or whatever's outstanding. So, and that can be done monthly, daily, quarterly, whatever you want to do, basically, as long as you don't exceed that 10% allowance. Should you overpay it? That is probably dependent on your circumstances. So have you got any other debts that need to be cleared? Because obviously credit card debt and personal loan debt is more expensive than mortgages. So it's all about it depends on, I guess, your circumstance and how quick you want to be mortgage free and how much you tie into that concept of being mortgage free and what your long-term plans are. If you're going to be upsizing in the near future, is that overpayment going to have a huge impact on your deposit when you factor in fees to then upsize? Or is that money just sort of going nowhere? how much interest you're being charged on other debts is a key factor, and how much is that going to impact on your affordability if and when you want to move. And ultimately, if there are issues with other things in the background, then there's advice you can seek out to help with that. Is it the right thing to do? I think it just comes down to your individual circumstances.
So, the 10% rule, is that hard and fast? So if, for example, you come into a big lump sum, you can't clear your mortgage?
You can. You'd have a penalty to pay. So when you're tied in for 2 years or 3 years or 5 years, you're tied in that product. So you've got an early repayment charge that's right for those 5 years or 2 years or 3 years. So you can do the 10% overpayment without penalty. If you're on a 2-year fix, you come into some money in the second year, you can make that 10% overpayment, sit on the rest of the money, and then when your product comes to an end, chuck it in all at that point.
We didn't actually mention this before, but when you can give the right details behind it, but I know when you normally get a buy-to-let mortgage, normally it's said that you should get interest only because obviously it's more a cheaper product than a repayment mortgage. So what is the difference between an interest-only mortgage and a repayment mortgage? Can you break it down into layman's terms?
Yeah, so a repayment mortgage is essentially if you are taking regardless of what product you go for, 2-year, 3-year, 5-year fix, and the length of term. So if you are on a 5-year fixed rate for 35 years and you take a repayment mortgage, if you make your repayments at the fixed rate for the next 5 years, and then you make your repayments for the next 30 years on the standard variable rate or whatever the rate would be, you are guaranteed to be mortgage free because you are making capital and interest. Your mortgage is clearing down. If you go on to interest only, then you are only paying the interest on that mortgage for the duration of the mortgage term. So if you go for a 25-year term mortgage and you borrow £200,000, at the end of that 25 years, you will still have £200,000 left to pay to the bank. So you need what we call a robust repayment vehicle in place to ensure that at the end of the 25 years or 30 years or whatever it is we've gone for, that mortgage can be repaid, be it sale of your property, investments, other properties you've got in the background. So we would always do a full check when it comes to interest only, make sure we're giving the right advice. You could do interest only on residential mortgages and buy-to-let. You could do repayment, of course, on residential. You could do repayment on buy-to-let as well.
So for those who have big savings stacked away somewhere, is an offset mortgage a good option?
An offset mortgage is a good option. An offset mortgage is, for the right person, a good option because an offset mortgage will tend to have higher interest rates.
Sorry, can you explain what is an offset mortgage?
So an offset mortgage is essentially where you will have a mortgage with a lender, and you'll have a linked account with that lender where you put your savings into. Now those savings then effectively offset your mortgage amount. So if you've got £400,000 in the mortgage and £200,000 in savings, you're effectively paying that £200,000 will sit in the linked account. You don't earn interest on that £200,000. But what you are doing is you are deducting that £200,000 from your £400,000 mortgage balance. So you're paying interest on £200,000 only rather than the full 400. So make sure you can actually clear your mortgage down quicker as a result of it. Now what we need to look at in that instance is what other rates are on the market at the time, because is that money you've got in savings going to be sufficient enough that it's better than getting a cheaper rate from another lender elsewhere that's not offset? So we'd have that conversation. We make sure that that you're looking at the right options. How long are your savings going to be there for? What are they for? Is it the right thing for you to be doing?
Okay, so another mortgage product that I've recently started getting into that we're looking at, because we're doing more advanced property strategies. So we're doing redevelopments, we're configuring and building interest-free flats, and we've had to go down the process of a bridging loan.
Yeah.
So can you explain what a bridging loan is and how does it work?
So a bridging loan is a short-term finance facility for what normally used when a property cannot have a normal mortgage on it. It's not habitable, or it needs work, or you're going to do something significant to the property to change its current layout. So that product is effectively a loan to you to do the work, to buy the property, whatever it might be. You typically don't pay anything monthly on that loan. Everything is deducted up front. So you have an amount that you can use, and it's normally short term, typically, let's say a year, and at the end of the year, you pay that bridging loan back either by selling the asset or refinancing to a lender who will then take the property on in its current state.
Okay, are there times when you would recommend a client does that?
We would always have, yes, there are times we recommend a client does that. That's going to be typically when you're, like I said, buying a property that can't be lived in for whatever reason or can't be let out for whatever reason. It needs refurbing, and your plan is to, whatever your plan is to do with that property, if a bridge is suitable and the risks of a bridge are understood, then absolutely we're happy to advise on bridging.
So when someone, for example, wants to move home, I've heard of something called porting your mortgage.
Yeah.
How does that work and what is it?
So porting your mortgage is effectively moving the product you've got from one property to another. So if you are currently in a 2-year fixed and you're moving home within a year, you could either sell, you can repay the mortgage to lender A, pay the penalty attached to that, and then get a new mortgage for the property that you're buying.
So you still have to pay a penalty?
Well, that's if you're going to change lender. So depending on what the rates are at the moment, if you've got a rate with a lender and it's quite high, and we can potentially get you a better rate for a new mortgage, it might be worth paying the penalty and borrowing money from another lender. If, however, it doesn't make sense to do that because your penalty is quite high, or you've got a good rate, or whatever reason, this lender is the lender of choice for whatever reason, you can take that mortgage to the new property. So you basically take that rate that you've got and you move it, you port it to the new property that you found. If you need to borrow more money, you can borrow more money from that lender then, and that lender will then give you lending at the current lending rates that are available. So you'd effectively have two products then with that lender. You'd have your first product you had originally, and then any additional borrowing that you've taken on top of that. If you don't need as much borrowing, then you would obviously reduce your loan size accordingly, and then maybe penalties attached to that as well, depending on how much you're paying back of the mortgage. Not all lenders allow you to port. Most do, I believe. Porting is not a right of the mortgage. You don't have the right to port the mortgage across. The lender has to approve it. It's a whole new application. So when you're porting, it's not like it's not a given. You treat it as a brand new application. So it goes through a whole underwriting, affordability tests, property checks, all that sort of thing. So it's almost like the same as a new mortgage application. The only thing you're not doing is you're not getting a new product, you're keeping the same product you had before and moving that to the new property.
Okay, because I literally thought it was you pick it up, move it to the next property. I didn't realise it was completely new.
In its simplest form, you're picking it up and moving it. When you break it down, it's a whole new application with underwriting and checks.
So I'm sure this is not true, but can you negotiate a lower mortgage interest rate?
Generally, no.
I thought so. Okay, just wanted to make sure. I've heard of that before, but okay,
no. I mean, in terms of when you're looking at lenders and the rates they publish, those are. I mean, the rates change quite often. So we'll always try to monitor the market, but as the rates that are published are the rates that you're going to get. As brokers, we sometimes do get exclusive rates, but when it comes to negotiating a rate, it's not really nothing you can do, unfortunately.
Okay, so on that point of you being a broker and getting exclusive rates, this probably is going to be a bit biased, but how important do you think it is to use a broker like yourself compared to a bank?
So the benefit that we add is more so around the service that we offer and how we can liaise with lenders, package cases correctly, get them to offer as quickly as possible without having to sit through 2-hour appointments with the bank for initial appointment, followed by another 2-hour appointment to do documents, followed by another appointment, and then potentially long-winded underwriting process. So the benefits of a broker are that we can see, you can go into your bank tomorrow and maybe get an appointment, but you'll only ever see the rates that they will offer you. You can go online and maybe do a quick search, potentially where rates are, but you never know if you're going to meet that lender's criteria. So we will always, as a rule, know what the lending criteria is going to be, who is the most suitable lender for you, who the underwriters are. We often have access to underwriters. We often are able to we will be able to package the case correctly. And the key really is speed and service as opposed to just rates. The rates tend to be the same.
Okay, that's actually really interesting to know, because I think a lot of people, when they're doing mortgage application, they're very time sensitive. They don't have the time to be waiting and going through meetings and documentation. So if they streamline the process and makes it quicker, it's always a benefit.
And you always have someone on hand you can call. You should be able to call your broker. We deserve some time off, but we are generally available quite regularly to take calls and understand and talk you through the process and give you guidance where it's needed and help where you need it. Whereas if you're dealing direct with a bank and you're limited to 9 to 5, Monday to Friday, you might get frustrated at that level of service or that process.
That's a good point, because I have messaged and called you at ridiculous times, and we've had conversations well past 5 p.m. in terms of obviously what we need, advice and that. So I definitely recommend that in terms of a broker in comparison to a bank. It doesn't stop at 5 p.m.
No, we're all human beings, and we have families, and we also understand that our clients have families, and we do our best to work around each other to make sure that you're always up to speed with things, and if you need us. And we always have people, so most brokers will have somebody who helps them on the side as well, an administrator or someone like that, a power planner to push the case through. So as brokers, we get quite busy, but we always have something to also look after our cases for us at all times.
Okay, so when it comes to the renewal time, I know we've mentioned this in this conversation already, but have you found in your experience that when it comes to the renewal time, it's always, not always, but you get a better rate if you change lender compared to staying with the same one?
It varies from lender to lender. So some lenders are quite, I don't want to say keen to keep clients, but I feel like it's more a case of they are quite aggressive or very positive in their existing client rates, existing mortgage customer rates. Other lenders do price a little bit higher than others. So it can be beneficial to change lender, which is why we would come in, because we would look at all your options as a broker to our clients. We say, well, the problem you have with staying with your lender is typically you've got a 3-month window before you can switch rates with your current lender. So using the example from before of remortgages, if your remortgage is due in 6 months, and we can lock in a rate now with another lender, we can do that 6 months in advance. We don't know, or we can look at what your current lender will offer you today, but we can't secure that rate until 3 months beforehand because of that window. So what we can do is obviously review that again with 3 months to spare to see, well, what is your current lender offering you compared to what we've got, and what's the market like as a whole.
Okay. And then when it comes to getting a mortgage, we know you need to have your deposit, you've got to pay obviously your broker fees, your solicitor fees. In terms of the actual mortgage process, from your experience, are there hidden costs that people forget about when they're getting a mortgage that you've experienced?
So your big sort of fees that you tend to pay. So you may or may not have a broker fee. You'll have a valuation fee potentially with a lender. A lot of lenders do offer free valuations, but what you might want to do is take the free valuation from the lender, and then once you've got the mortgage offer from the bank, you might want to do something more in depth, a more in-depth survey. So like they used to be called a home buyers report or full structural survey. They're called level 1, 2, and 3 surveys, I think now. So you might want to get one of those done as well afterwards. That could be anything from 500 to thousands, depending on the sort of property that you're buying. You have your legal fees. So when it comes to solicitors, you have to remember that the solicitor's working not just for you, but also for the bank. So they're looking after both interests of the transaction. The solicitor will charge a fee for working for the lender, and they'll also charge fees for working for you. So you'll have disbursements to pay the solicitor as well. And then you'll also have a lender admin fee. Typically, if it's a residential mortgage, it might be around £1,000. If it's a buy-to-let mortgage, it may be a little bit higher than that, depending on the product. Lender admin fees can be added to the loan. So more often than not, we do tend to see clients adding the lender fee to the loan rather than paying it up front. Again, you don't have to do that, but a lot of people do it, or they might just pay that fee at completion or after completion to get it gone, because obviously you're incurring interest on that fee. Other fees then outside of that you'll have are, I guess, moving costs, post-completion fees, have you got rent to pay for a couple of months, whatever it might be, or have you got to pay a big moving van, or how far you're moving? Those costs are obviously going to be factored in as well. And
my final question, for anyone who's looking to get a mortgage right now, what's your top piece of advice for them?
Speak to a broker.
Right, amazing, Adam. I really appreciate your time.
You're welcome.
It's been a great conversation. There's been so many gems that you've dropped that I'm sure many people will latch at and have more questions. So if you do have any questions for Adam, drop me a DM. We can link you up with Adam and get you started with your mortgage process, get you buying your house, get you getting your investment property as well. But Adam, thank you so much.
You're welcome. Thank you for having me again.
Amazing. Thank you.